Now, really briefly, we're gonna go over, what it means to buy option contracts. There's two sides, buying an option, selling an option. But today we're only gonna go over what it means to buy an option contract and basically what you're buying, what it takes to buy one, and basically what does it do for you as an investor or trader. Now, let's assume in this example, a share of a stock is $100 per share. Now, if you were to buy the $90 call, like in this example, you're basically buying the rights to buy 100 shares at $90. And generally, to open up a call, you're gonna need to pay a premium, which means you're paying someone else that sold you that call option to open up that position. And basically what that means is, regardless of what this price is, you are able to buy 100 shares for the strike you bought it at, in this example, $90. So that means if the share price went up to $1,000 per share, you still have the right to buy 100 shares of that at $90. You obviously profit the difference. Now, let's say in the example, this goes below $90. You still have the right to buy 100 shares at $90. But if this stock is now worth $80, it simply wouldn't make sense to buy 100 shares of them at $90. You might as well close this position, collect whatever premium you have left in that contract, and just buy 100 shares at $80 or whatever price it is now below that strike. Now, on the flip side, what does it mean to buy a put? Let's say in this example, you bought a $110 put, right? The share price is at 100, but basically you are buying the right to sell 100 shares of stock you own at $110, which basically means, let's say that $100 share price, something happens in the news, it drops to $50 per share. Well, if you have a put option open and you bought it, that means you still have the right to sell 100 shares of that stock at $110. Basically, you're just profiting the difference at that point. You thought a stock was gonna go down, you bought a put to safeguard that, it actually went down. And you might have lost money on the equity of your shares going down, but you are profiting on the fact that you're still able to sell it at $110. Now, you're still paying a premium to open this position, but one thing to understand about premiums is it's built up between two things. The intrinsic value, basically the difference between the strike price you're buying it at and the share price. So in both examples, the intrinsic value is 10. Obviously times it by 100 because you're buying 100 shares or selling 100 shares. And the second component of a premium is the extrinsic value. How far away till expiration is that contract? And also, what is the implied volatility on the stock? What are the Greeks on the stock? Most basically, easy way to explain that is, what do the market makers think the stock will move up or down, kind of the standard deviation of that movement, and kind of pricing that into the option.